the needs on both sides. We've talked a lot around the informal market. What are their needs? Understanding that, getting out there, understanding the issues that they have to deal with on a day-to-day basis that aren't represented in this room. However, on the other side of the equation, we also have to meet the suits. We also have to meet their needs and know and understand what it is that they have to do, how we address their issues, what are their requirements in order to liberate that capital. And while there is capital available, we need massive capital. We need capital on a massive scale. How do we liberate that capital? We can only do that by providing them with the support and information that the capital needs in terms of the solution. So it's about linking the two together in such a way that we can address both sides of the equation.
Stephen, anything from you?
Yeah, I like this issue of collateral. And I come from a background that collateral is not what pays your loan. That's my starting point. Collateral is not what pays your money, brings the money to your bank. It's about a character. And we talk that we lend because of character. And how do you analyze a character? And a character cannot be quantified. It's qualitative. And that skill of analyzing a character, that is what is the game changer, and that is what microfinance institutions have thrived to date, because they have perfected the art, because they know clients pay, because when they know what is this client they're dealing with. And it constitutes to 70% of the analysis. 30% is what is quantitative. Is this flipping the whole thing over.
Can I add to that?
Yeah, please.
The microfinance have also done something else. They start small. You don't start with a big loan, you start small. And it's the same basis of the starting small. We need to start small and build, and you build character and credibility. To add also to character is community. Again, we come from a Western background of finance, which emphasizes the individual. And community is such a key part around that. And the SACCOs and the other microfinance institutions understand that community is also a key part around character and support. And it's around local pressure. Again, this is why decentralization is so important. Local pressure on repayment to a centralized capital source is what's key to the success.
Thank you. And just to touch on that, I know you have a good example in Mozambique. Can you talk to us about the product there, this decentralization, and how you are working through that so that people can see that these products can be designed even for the informal sector and the outcome?
Yeah, sure. So Mozambique, as you know, is one of the poorest countries in the world. Beira is one of the most climate-impacted cities in the world. And so the product there is designed in such a way that the lease to own, the TPS as you call it here, is designed that there is a minimum payment, which is on a monthly basis. But contribution is done as and when money is sourced. So whether it's seasonal or whether it's a catch, as in our fishermen, our one customer is a fisherman, so whether it's based on catch season, that takes into account the reality of their income. The customer wants to own the home. So the repayment mechanism, putting it as a minimum repayment with capital contributions in finance speak, has enabled the customers to contribute, and they're already ahead of payments. So again, it comes back to risk. This market is perceived as highly risky. In fact, if we create products that are desired, like we're talking about, the reverse is actually true. It's not risky. It's just a question of how do we address that risk. And that element is, we needed data to support that, and we've now starting to build that data in Mozambique, which is a key element of that. The other part of that is the information back to the investor. We need to report that information back to the investor in such a way that we can attract investment in and provide the pricing mechanism and liquidity for the investor so that they are also not trapped for 20 years in terms of a mortgage, because that's one of the key issues in terms of attracting international investment, obviously, is international investment into Africa is perceived as risky. So how do we create liquidity around that? And that's the other side of the equation that we're addressing.
Thank you very much. Stephen, can you just, I know you are deep in this space, what are the current processes of underwriting by financial institutions in this segment? Just good examples for us, you know.
The whole process, take it simply like one is there is alternative records that you look at, not the traditional financial statements that you will expect an audited financial to bring you. Those ones, you will never get them with this segment. So that one you pack. It's all about, for those ones who did accounts, it's about incomplete record keeping. You are constructing their records. So it calls for understanding of the enterprise that you are underwriting. So it calls you for vast knowledge of almost everything and anything if you are the loans officer doing the underwriting. So then it calls for what is the type of training that these staff are taken through to equip them to deal with this segment. That is the missing gap.
Thank you very much.
Can I also add to that? I think another element in terms of that is looking forward instead of backward. So much of our financial system is based on looking backward and proof of record, as we referred to, which doesn't exist, but it also implies that you have to come from money, which is why the rich get richer. So the whole thing around it is, how do we look forward? How do we create reputation going forward? And again, the TPS is a mechanism in which to do that, whereby if we can create individual credit records of payments that belong to the individual, not to a financial institution, that they can utilize going forward, we are creating credit histories for those individuals. So let's look forward. Let's create technologies and support for looking forward instead of looking backward, because that's what we're trying to do, is uplift and move forward with people who traditionally have not had funding or finance in the past. That's exactly what we're doing. So if we're expecting it, we're going about it completely the wrong way.
Thank you very much. Okay, I see hands going up now. I don't know if it's time to start asking. We throw it up into the audience. Sure. Yeah, okay. Who's moving around the microphone, please? There's first gentleman there, the first question.
Hi, David Ross of Stratera Capital. So thank you both. It's great speaking with both of our panelists earlier individually, and the mention of utilizing the methodologies of microfinance in the housing sector. We see new non-bank financial institutions going into providing asset finance, and perhaps, but not as long of a duration as would be in the case of housing. And you mentioned it very, very clearly, Stephen, about character. What tools are out there when you meet a borrower, a prospective borrower, for the first time to assess his or her character? Are there a psychological test? Do you ask his or her pastor? And most importantly, how do you do it at scale to achieve the opportunities to reward the good parts of that 80% of informal sector that will do everything they can to make good on their credit? So I would love to hear any tools or resources that people are utilizing to find those the people that should be rewarded for a good character.
It's a fantastic question. So maybe Stephen will go first.
Okay, so I'll go down memory lane where microfinance started, and that's where I started from. That's 30 years ago. At that time, there was no tech and there was nothing. And in the early 90s, you'll give $20,000 against no collateral whatsoever. How was that happening? If you look at $20,000 in the early 90s, how much would that be now? Just phenomenal amount. So one of the key aspects is about, everything is not about tools. It's about building relationships. A person will pay you because of the relationship. It's an art, it's not a science. I'll say so.
You want to take?
Yeah,
We'll come to you shortly. You want to take a stab at that?
So Stephen, maybe you're a little bit older than me, but I'm less traditional. Personally, I believe that we can develop tools, and I think around it comes to a question of exactly that, using the other aspects of microfinance. Because in order to get it to scale, we can't rely on relationships. So we have to build tools, and part of that is as I mentioned earlier, it's looking forward rather than backward, starting small and building to scale, and community, relying on the input of others around in the community to validate and support mechanisms, because that's the closest that you can get in terms of being able to take that to scale. And that's a key, those are the key parts around building decentralized systems that enable us to do that, to de-risk the process.
Thank you. Casey?
Thank you. I was hearing you, Glenn, you talked about that we need to come up with other ways of documenting people's financial habits. And it strikes me we are in the center of digital finance. And M-Pesa is everywhere. Can you not just use that?
There's certainly tools that you can do to use that, absolutely. Obviously, it's very proprietary, the information.
Why?
Because it's valuable, because it's extremely valuable. So the proprietary information is you can't get access to that information. So generally, it's very difficult to get access to that information. So really it comes down to then relying on other mechanisms, because that information is proprietary. And actually, that's one of the key parts, again, around decentralization, because that information should belong to the individual, not to the institution. Whether that is Facebook, or whether that is WhatsApp, or whether that is M-Pesa, or any of your financial information, it should belong to you. And again, that's one of the key things around what we're trying to do in terms of building that credit history, is to build a credit record that belongs to the individual, not to the institution.
Okay.
Just one little follow-up question, and I don't know if that's something you've explored in Kenya, but what are the regulatory issues around that? Is that actually possible? Because it seems this is quite a developmental issue. I mean, it's a critical issue for the development of financial inclusion, and there's a real opportunity here. So are there regulatory barriers to this?
From the top of my head, I would think that it also has some data protection questions around it. I don't know if you can just easily share information that you get from M-Pesa and use for your own analysis, but I don't know what the rules are here in Kenya. But if you look at the European General Data Protection and all of that, it makes it almost very, very difficult. So you have to, in my own assessment, develop those methods yourself, maybe gathering your own data and then making those informed decisions from your analysis. We'll go here now.
Hello, good afternoon. Thank you for your time. My name is Max. I'm into the mortgage brokerage business in Kenya. And when it comes to lending for housing for the informal sector, Stephen mentioned that the relationship matters. And I was thinking, all these people, they are renters today. And there's one person who knows them well, it is their landlords. Do you think there would be a way to work with the landlords, for maybe the landlords to be able to sell to their tenants and then continue managing their mortgage payments and still collect fees for managing these payments? Because landlords know how to make sure this person pays. He's been doing it for the last maybe 5, 10, 20 years. They can continue doing it for the next 10, 20 years as well.
Stephen.
That will bring me now to another question. I didn't want to go there, but now you've raised it. I will hint on it. Anything that you do, it has a model, and it has a way that you will deliver that product. And every segment of your market, it will not be delivered the product in the same way, which rarely, when you look at most institutions, is the same. where that differentiation, if it's not there, and you're working with the informal sector, it will be a big struggle. There has to be that differentiation of your model of delivery. Because the issue is not just giving the client money. That's a once-off. That is easy. There's the issues managing that facility for the entire period, which is that's the model of money M&E, which now that brings in now the whole cost of monitoring, makes the whole business how expensive or how cheap you are. So it's about the whole model of just disbursing, but also monitoring that facility.
We'll come back to it in 1 second.
Can I also just give an answer to that? Because I think, again, it's also around forward-looking. Because historically, it's around the forward-looking. What's the risk? If we do a TPS, what's the risk, actually, of the tenant coming in and not paying? The risk is that we have to move him out, and there's a cost associated with that. But again, depending on the environment, that is either relatively simple or quite complex. But that depends on the area that you're in, etc. So if, again, we start looking forward instead of backward, and we start saying, can this individual, what's his current payment, and is he paying that at the moment? Is he going to pay that going forward? Even the last 5 years, historically, it gives us an indication of how he's going to perform, but it's not a defining mechanism, because for his own home, he may pay it completely differently. So again, if we structure it taking into account knowing that he may have challenges financially, and to account for that, instead of punishing him for that, I always use him, her, because they're better credit. Better credit. The opportunity exists for her to do that going forward. If we can structure it in such a way that we build it going forward, we define the risk going forward, we reduce the risk going forward. And then instead of giving the funding to the individual, we're giving it to the institution who's incentivized. Another key part around this is aligning everybody's incentives. And right now, we don't have everybody's incentives aligned. And that's part of the challenge, and it's why we have that. If you think of a bank, the challenges that they have with deposits, and the legislation, I understand the challenges. It's challenging to lend to this market. But they are also incentivized to maximize the profit out of this. So they're incentivized to take what we can out of this sheep and maximize every piece that we can. And that's also not the right approach when dealing with this market, because we actually need an equitable approach. So how can we align everybody's incentives when addressing this market? And I think that's a key aspect.
Thank you very much. We're out of time, but we'll take your question.
Yes, thank you very much.
Yeah.
My name is Matthew. I'm from NSF Uganda. I'm curious about, because the themes that I'm hearing are collaboration and data and guarantees and risk sharing. I'm curious about if there have been any initiatives where, let's say, SACCOs and savings cooperatives, as opposed to underwriting just the individual, you use that social group and his connection to that social group, and perhaps that social group would guarantee each member. Has that, as such, an initiative ever been explored?
Yes, those discussions, it hasn't been implemented yet. The discussions are underway, as are the technologies to support that process. So how do we create a mechanism? Because again, it comes back to how do we manage it? It sounds a great concept, but we actually need the tools to manage that process, and it's having the tools to do that in a way that we can take it, replicate it, expand it, and maximize it. So yes, to answer your question, yes, the discussions are underway. Is it in place yet? On our platform, not yet, but the discussions are underway.
Stephen, last one from you.
Yeah, just on that aspect, and this is always my theory of change when it comes to housing. Housing must be anchored on livelihoods. Like when you look at this particular entity that you are going to engage with, what are the economic activities that they're doing? That then when now you are coming now to structure the whole deal, it brings now those variations. Like I remember, just to give an example that you're saying, what is the model that has been done in Tanzania with one of the microfinance banks, this is what we tried to do. It was with cashew nut farmers. So what this microfinance bank did, so it was acting like an aggregator. That's where now the creativity and innovation comes. So if you don't have the appetite for innovation and creativity, you miss a lot of opportunities. So it's seeing what is the opportunity ahead of you. So what this institution did, it went into partnership with a cooperative, which works with these cashew-nut farmers. This microfinance bank was providing a housing facility. So it was acting as an aggregator, working with the manufacturers, getting the price of iron sheets at half the price, because it's acting as a guarant, as an aggregator. So there's a lot of creativity that when you look at the business opportunity and creating a value proposition for each actor, things can be done.
Thank you very much. I've
Thank
been
you.
told that we have completely run out of time. This discussion can continue afterwards. Thank you for your time, and then we are still available to talk to you. Thank you. Bye-bye.
Thank you so much for that session.